Hello, and welcome to our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, after a very strong stretch for markets, we finally saw some weakness last week. The S&P 500 declined 2.6%, and small cap stocks were down nearly 3%. Now, international markets weren't down as much, but they also pulled back, and bonds struggled as Treasury yields moved higher. What's interesting is that the weakness wasn't driven by deterioration in the economic data. In fact, many of the key economic reports that we watch came in better than expected. So this week, I want to focus on three questions. One, is the economy still supporting the bull market? Two, why did markets react negatively to that stronger data? And three, what should investors make of the growing wave of AI related IPOs? So the biggest story beneath the surface last week was probably those higher interest rates. Stocks and bonds both declined at the same time while the dollar strengthened. Now that combination, that's not usually signaling that a recession is ahead. It's usually just investors adjusting their expectations around inflation and Fed policy, expecting higher for longer Fed policy rates. Now, the economic backdrop remains surprisingly resilient. Manufacturing activity has improved meaningfully, job openings moved higher, and as we can see here, payroll growth continues to come in strong and exceeding expectations. Now, while growth has clearly slowed from the post-pandemic boom, the data does continue to support our view that we're seeing moderation in growth, not recession. And that distinction matters because earnings typically deteriorate before major bear markets. So today, earnings expectations remain healthy and economic activity remains positive. So, if economic data was solid last week, why did markets choose to sell off after 9 straight weeks of gains? Well, the answer is that good news can sometimes create a different challenge. For much of the year, investors have expected eventual Fed easing. Stronger labor market data and sticky inflation pressures, that makes it a higher hurdle to ease rates again. And it's more likely that the Fed's going to remain patient. So the concern right now isn't recession. The concern is that rates may stay higher for longer. And when rates rise, markets become more sensitive to valuation. And that helps explain why both stocks and bonds were under some pressure last week. Now, a topic we're increasingly hearing from clients is the upcoming IPO pipeline. So, potential future listings include names like SpaceX, OpenAI, Anthropic, Databricks, and Stripe. Collectively, the potential pipeline exceeds $4 trillion dollars in private market value, about 3 trillion just in the top three names alone. Now, many investors worry that passive index funds will eventually need to buy these companies, forcing sales elsewhere. And there is some truth to that concern. However, I think the bigger lesson is understanding why these IPOs are appearing now. So, this was one of my favorite insights from the research that we reviewed from last week. Historically, strong market returns lead IPO activity. Expanding valuations lead IPO activity. Improving economic conditions lead IPO activity. In other words, IPO waves typically emerge because markets have already performed well. So the sequence is often strong returns, higher valuations, more companies decide to go public, then future returns become somewhat more muted. The IPOs themselves are often less the cause and more the symptom of a strong market cycle. And we can see that on the chart on the left here that IPOs tend to pick up when broad stock market returns have been strong. The chart on the right shows that the highest positive correlation of returns to new IPOs is the performance of the market in the 4 to 9 months before the IPO market heats up. And the most negative correlation is about 16 months following those IPOs. So, in other words, IPOs pick up because markets have been strong. But understandably, markets tend to be a bit weaker following those IPOs as the market had already been very strong. It's not necessarily because of the IPOs. The offerings are more a symptom of strong market conditions. Now, the historical evidence suggests that larger IPO waves are often followed by lower forward returns and less multiple expansion. But that's an important nuance. Lower returns do not automatically mean negative returns. The research found that only about 20% of the largest IPOs coincided with major market peaks. Most occurred during ongoing bull markets. The implication isn't that investors should fear the IPO wave. The implication is that future returns may need to come increasingly from earnings growth rather than ever higher valuations. Now, the research also argues that the bigger risk may not be to the overall market. It may be leadership rotation within the sectors that those IPOs debut in. So today's AI winners benefit partly from scarcity. If investors suddenly gain direct exposure to OpenAI, Anthropic, and other AI leaders, some capital could rotate away from existing AI proxies. And that could create winners and losers within technology without necessarily changing the broader market outlook. So the table here shows that following the largest IPOs in each sector, the tech sector performance has tended to moderate, gaining about 20% in the 6 months before the large IPOs and 10% in the 6 months after. And that pattern of moderation following the IPOs in each sector is pretty consistent across the other sectors as well. So, bringing it all together, my bottom line is that last week's decline looks more like a valuation adjustment than a deterioration in fundamentals. Economic data remains supportive. Earnings remain healthy. The biggest risks today are less about recession and more about interest rates, elevated expectations, and potential leadership rotation. And that's why we're maintaining diversified portfolios across US stocks, international stocks, small caps, and fixed income. The environment is becoming more demanding, but the broader bull market foundation remains intact. And that's what we have for you this week. And as always, I want to thank you for listening and wish you a great week ahead.